Okay, good evening, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that it is indeed working. Hope everybody's having a fantastic evening so far. I'm looking forward to trading with you guys this evening and looking forward to going over the COT report. This is one of my favorite webinars each week, so excited to host it and go over what I've prepared for today. As always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is, and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, awesome. Like I said, I just want to welcome everybody here. Also want to give a shout out to those of you watching this in the recording. Want to say hello to you guys as well, and feel free to participate in any way you can. If you have questions, feel free to ask those questions in the chat box. If you have questions, feel free to put those questions in the like if you're here live, if you're here in the recording, feel free to ask those questions in the comment section down below. All right, guys, well, let's jump into this. So first, I just want to quickly explain what the COT report is, and then we'll mostly spend tonight just how it integrates with the scanner, because that's 2/3 of the scanner is the COT report. And so we want to make sure that we cover that. And I also like the fact that tonight was a sentiment webinar, because we are able to kind of explain how sentiment interacts with the COT data and the scanner. And then I wanted to explain how the COT data interacts with sentiment data and why we're able to capture such significant and such accurate signals on a week-to-week basis. Okay. All right. Well, like I said, so the CFTC, this is the Commodities Futures Trading Commission. They're a financial regulatory here in the United States, and they make sure that the futures and commodities market runs smoothly. And one of the things that they do is they release the COT report, or the Commitment of Traders report. And it's a totally free report, and it comes out once a week, every Friday. Okay. So, what is significant about the Commitment of Traders? This is it right here. Well, this is a report that tells us what the banks are buying here in the United States specifically. And this is specific to futures contracts. So a lot of people ask me, like, hey, why is the COT report valuable? If Why would I use the COT report if it only looks at futures data and looks at um, the commodities market? Don't I want to look at the regulatory authority that looks at the Forex market? Well, the thing is, so in the United States, and this is actually globally too, Forex is a decentralized market. So that means that there's not an exchange that regulates and monitors Forex. Now, each country can determine if Forex can be traded in their specific country. Like here in the United States, you can trade Forex, but we have a ton of rules, like a ton. We have FIFO laws, we have hedging laws. You can't hedge in the United States as of 2008 as a Forex trader. Like I said, FIFO became a thing after 2008 here in the United States. And other countries have other rules, like in the United Kingdom, in England, they allow a lot more leverage than we have. Like here in the United States, we can only trade 50 to 1, which is plenty of leverage in my opinion. But other places will let you trade 500 to 1, 1,000 to 1. I've seen one place that actually does 4,000 to 1. Let me know if anybody has seen something bigger than 4,000 to 1. I feel like if you took a trade 4,000 to 1, like like and you maxed out your leverage, you'd be out of money like the moment you took that trade. But anyway, let me know if you've seen something bigger than 4,000 to 1. But yeah, that would totally not be legal here in the United States. Like I said, our max is 50 to 1. And so the CFTC actually has a big arm in Forex in the United States. So they regulate companies like Awanda, Forex.com, TD Ameritrade, some of these other places where you can trade Forex. But specifically, most banks here in this country don't buy Forex pairs. what they've seen, um, or what, yeah, like I said, most banks don't trade forex pairs. What they do is they trade futures. So what is a futures? So a futures contract is a way for you to um, basically participate in, well, not, it's not forex trading, but you can buy like euro futures, you can buy pound futures. So if I click on like the most standard COT report, which is this one right here, it's the Chicago Mercantile Exchange short format. If I click on this here on the CFTC website and I search the euro, you can see um, this is the euro right here. These are euro contracts. Okay. And so you've got the non-commercial and you got the commercial side of the market. Okay. And these are just different bank participants that buy euro futures. Okay. And if I search like the Australian dollar AUD, I've now got Australian futures. Okay. That's what we're looking at. Now, people ask me all the time, they're like, and especially on YouTube, people ask me, like, why do you trade? Why do you use the COT report if that's not even a Forex report? Well, the thing is, these guys still trade futures that are directly related to Forex pairs. So if this is like half the story. So if I know what the banks are doing with the Australian dollar specifically, but I also know what they're doing with, say, the euro, well, that's going to tell me the full story on the euro Aussie. See what we're doing? So if I can find out what the banks are doing on the Japanese yen, but also on the US dollar, that's going to really help me on the dollar yen currency pair in forex trading. See that, right? And so that's the thing, like too, like a lot of people who trade um futures, they love the COT report. Forex traders don't. I feel like a lot of forex traders don't. There's a lot. I feel like most traders still don't know what the COT report is. It's becoming a lot popular because of how valuable it is. I've seen a lot more people kind of gain interest in the COT reports over time. But the thing is, it's actually still pretty hard to trade the COT report. I've noticed a lot of people don't really know how to use it, but we do. Like we have a really, really good edge with COT report data, and I'm excited to share with that edge, and we'll show you what we do. But um, let's kind of start here. So this is what a COT report looks like. So again, it stands for commitment to traders. It shows you what the banks are buying and selling each week. And there's one that comes out every Friday at 4 p.m. Eastern. So a lot of people love our company because they love our strategy. And our strategy is very simple. We basically take trades at the beginning of the week and then we hold those trades until Friday. It's that simple. Like that is the strategy. There's not like this extra guesswork about charting or candlesticks or whatever indicator. It's just simply here's your COT data, here's sentiment data, here's the signal. Take the trade and go till Friday. That's it, right? It's pretty simple. And that's really how COT report data ought to be traded if you think about it, because you get a publication once a week. You might as well sync up your trading to be a once a week ordeal, right? If you're trying to use the COT report data as a signal to decide where you're going to go for the next 5 minutes, 15 minutes, hour late, if you're going to be a scalper, COT report is really useless. And I think what happens is a lot of Forex traders come from that mentality of, pulling out their coffee in the morning and trading for like an hour and then they're done. Well, the COT report probably isn't going to be very useful for that type of trader. And so I'm not going to advertise the COT report to somebody who's that way, who wants to just get up, pull up their slippers and their coffee and sit and make a couple $100. It's just not that way. If eh, and I've tried that type of trading before. I've done that kind of thing where I've just gotten up, set up my computer and started trading. And, sometimes you're successful, sometimes you're not. I find that type of trading to be massively stressful because you're trying to make your income all in like 1 hour. And if you place a position and that trade loses in 5, 10 minutes because you were wrong and you're done for the day because you hit 2 or 3 losses, like that, I hate that. I really just and I never found a level of consistency when you're trading on the smaller time frames too. One of the things I noticed is you're working with spreads now. Spreads are an issue, and I don't really care about spreads. So a lot of Forex traders worry about what broker they're using, and I'm like, I don't really care because I'm a swing trader by nature because I hold trades for several days, sometimes weeks at a time. And so the spreads don't matter to me as much, although they do matter. It's just not like, it's not like the end all say all because I'm not a short-term trader by nature, right? So like I said, if you take the COT report to you, you're going to fail. But if you go to where the COT report is, the COT report could actually be one of the most powerful things you do in your world of trading. It really could be the greatest thing since sliced bread. It really could. I know dozens of traders who can share the same opinion as me on that topic. Okay, so let's break down the COT report. So, like I said, let's go back to the euro. So when I'm looking at a COT report like this, they're really big. Okay, look at this slider over here. This is so much data, and most of it you don't need. Okay, and they're very boring to look at, but they're absolute gold in my opinion. So let me go back to the euro. Let's go back to the euro right here. This is this is a entry right here. This whole thing's an entry. And then just below that is another entry. Okay, so that's a COT report entry. And it'll tell you what it is. It'll tell you the instrument. So this is Euro FX futures on the Chicago Mercantile Exchange in the United States. These are future only positions as of Tuesday, January 9th, 2024. Now, you might say, wait a second, that was a while ago. That's the most recent report we have. Yeah, that was 8 days ago. Yeah. So basically COT reports, they come out every weekend, but they collect data on Tuesday. So all the non-commercial and commercial participants, these are banks with different purposes, they release their data to the CFTC every Tuesday. And then from Tuesday to Friday, the CFTC will then compile the COT report data and release it Friday at 4 p.m. Eastern to the general public. Okay. So you're really looking at data as of that date. Okay. So a lot of people, again, this is a big thing. People say, well, you're looking at kind of historical data. Well, isn't that what data is? It's history. It's all historical. But people say, well, that's not going to help me with my short-term trading. And it goes back to my last conversation I just had with you. Again, don't try to take yourself to the COT report. Try to align with the COT report because the COT report's not going to change. You can't control the COT report. So try to get yourself to align with the COT report because it's not coming to you. You have to go to it. Okay. So a lot of people, like I said, a lot of people who are short-term traders, they try to bring COT data to their short-term style and they want the COT report to tell them what the market's going to do in the next hour, and it's just not going to work. It is very much a longer-term swing trading tool that I love. I think it's one of the greatest tools out there. And if you're that trader who just needs consistency, like I'm showing you consistency and it's a gift from the banks and the government and it's totally free, here it is, right? Okay, so let's break down the next part. So this is all easy to understand. You got all of this, you got this, the date, and then you got non-commercial and commercial. So we do need to have a little conversation on this because this is very much in line with the scanner. Okay, so non-commercial data. What is non-commercial data?
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve's scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code Friend of Steve, that's Friend of Steve, no spaces, at checkout and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
Non-commercial is the large specs or large speculators, right? These are the big banks who take outright positions. That's an actual financial term from the COT, from the CFTC. They take outright positions with the sole purpose of just making money. That's all they're trying to do. Okay. And they don't invest for other clients typically. Um, I mean, some of them do, right? But it's not like they have different interests for investing in futures other than just the purpose of making a profit off of their speculative position. That's all they're there for, right? Then you have the commercial side of the market, right? Commercials are basically people who they're institutions that have another purpose other than just making a profit, an outright position. What commercials like to do is they like to take positions with the purpose of like hedging a product or a service. So an example of this would be farmers in the Midwest who take positions because or they have crops that they're farming, or they have agriculture, or they have whatever it is that they sell, and they want to hedge their bets off of their crops. And so if they want to stabilize their business, they'll use the futures market on the Chicago Mercantile Exchange to hedge off their business. That's who commercial participants are. And they represent a very large portion of the market, which is key. And this is like the thing, this is like the secret sauce right here. Like nobody talks about this thing, right? Every video I've seen on the COT report on YouTube, and trust me, I've watched hundreds of hours of content on the COT report. Okay. Um, Everything I've seen, everyone has this relentless infatuation with the non-commercial data, and they're not necessarily wrong. Because non-commercials are basically your um like non-commercial are your large specs. Those are the big banks. So we typically want to follow them. But the difference is the commercial side is usually the much bigger side of the market, right? So if you look at this, you can see here the amount of long contracts that are tied to commercial. And then over here, you can see the number of long contracts that are tied to um, non-commercial. So you have commercial and non-commercial. We have nearly double the amount of long positions on commercial right here, as you can see, than we do on non-commercial. Why is that important? And this again, like I haven't seen anybody talk about this other than our group. And I think it's starting to spread because I did actually hear from I did hear from one guy that there actually is a YouTube channel in Australia or something like that that they're starting to pick up on this. So we're like at the cutting edge of something which is really, really cool, that a lot of people haven't really figured out. Um, and we've already built a scanner behind this. Like it's pretty legit. So basically, like I was saying, this is the bigger market. Also, notice the difference. Here's the short positions on the commercial side. Over a 500,000 short positions on the commercial side, 566,000 contracts versus 89,000 contracts on the non-commercial. So, like I was saying earlier, these guys, the non-commercials, these are again the people that are most aligned with our style of trading, right? These big banks trade like us. They are trying to make money. That's all they're trying to do. That's what you're trying to do. That's what I'm trying to do. That's why you're watching this video, is to get more knowledge on how you can apply this information to put more money in your pocket, right? But again, non-commercial commercials are not like that. Commercials, they just use the futures market to simply hedge against just to hedge their product or service to stabilize their business. Or clients that they have clients that require some kind of hedging contract in their pension plan or whatever. So these guys represent a very large portion of the entire market. Now, again, they're not very good at trading because they're not using it to trade with. So why am I talking about this? This is the point. They are so big relative to non-commercial. These guys are so much bigger. When they make a shift in the market, and if it's significant, it ripples and has profound effects in the market the following week. That is the secret. That is why this works. Boom. Okay. And again, I think, like I said, we're the ones who have the cutting edge on this. And there's like one other group that may be getting on board with this, but very few people talk about this very subject. So when these guys shift on a week to week basis, the market often follows the shift or the subsequent direction that they went. Okay. Is it perfect? No, nothing is. But is there a high level of consistency and probability that the market will go in the direction that commercial shifts the following week? Oh, yeah. I got all sorts of back testing, forward testing to prove it. Oh yeah, it's like one of the most consistent swing trading things I've ever run across in my 11 years trading. So this is really, really cool. And we've, of course, built this into the scanner. Very, very exciting stuff. Um, Now, again, you don't want to follow these guys long term because usually they take a contrary view to the market because they're trying to hedge their product services for different purposes, right? That's why they are who they are. Now, people ask me all the time, well, don't you just want to follow the commercial side because they are the biggest market? That doesn't necessarily mean that the market goes in their direction. I just want to make sure that that's very clear. Um, they, in fact, like I said, they often go in the wrong direction because they use it as a hedge. So it's not like they're even trying to make money with it. Sometimes they literally take futures positions to lose money. I know that sounds crazy, but it's there in case like let's say like I'll give you like this will make sense for those of you that are perplexed by this, okay? I think this will make sense. So let's say you're a corn farmer and you have 5,000 acres. You're huge. Okay. You have a huge corn farm. All right. And you're expecting this crop to be really, really good. Okay. And everything's on schedule. You're about to harvest. Everything looks good. But you, um, but there's a chance that there could be a tornado or there's a chance that there could be a storm that comes by and ruins portions of your crop. Okay. If you wanted to ensure that because here's the thing, if let's say that tornado destroyed your farm for that year and you need those profits so that you can stay in business the following year, what you're going to do is you're going to go place a short position on corn, or you might go do something, right? Like if you own enough corn that if your crop went down it would affect the entire market, you might go in there to hedge your bet or something like that, right? This is just an example of what I'm trying to illustrate. You'll hedge your bet because if your farm's going down, there's chances other people's farms are going down too. And if you live in an area where everyone you like make all the corn in the world or whatever, you're going to put a short position out, and so is everybody else. So everyone's expecting a good year, and you're going to have a good year. But like if that black swan event comes in and wrecks everything, you've now got some levity there to work with. Okay. See what we're saying? That's why commercials are huge. Okay. And it's not just one farmer, right? We're talking about everybody who participates in that market to do that very thing. So they often are in the wrong direction, but it's just to stabilize their business. Okay. So they purposely take a trade that goes in the wrong direction. I know that sounds crazy, but it's again, I hope that example clears things up. But then you got non-commercials. Again, these guys take trades in the right direction most of the time. And so that's why we want to follow these guys long term. So right now, most banks, as you can see, have long positions on the euro, and they have smaller short positions on the euro right now. So it's a much larger bias to be buying the euro than it is to sell it. We do monitor this, but when these guys shift on a week to week basis, it doesn't necessarily equate to a um like we don't necessarily see a big move in the market when these guys shift. Okay, they actually don't make a big enough surprisingly, right? They actually don't make a big enough move on a week to week basis to have any, from what I have found, to have any real significance in determining the direction of the week. But like I said, if commercial does change, it has profound effects the following week in the market, sometimes several weeks in the market. So let me give you an example. So when you look at the scanner here, guys, here's the scanner. If you filter this option right here, it's like the fourth column in on the scanner where it says weekly shift. If you filter this, it'll bring up the number one shift trades for the week. So, um, these are the ones that had the biggest shifts. Like, so NZD CAD had a really big positive shift. NZD Franc, pretty big positive. NZD Yen, really big positive. Gold had a positive shift. Euro Aussie had a pretty big positive. If you flip it the other way, here's some pretty big negatives. Aussie Kiwi had a really big negative. Pound Kiwi, negative. Euro Kiwi's negative, right? And so on. Okay. Aussie dollar's pretty negative, right? If you filter this column right here, that's what you're looking at is the shift in COT data. And these are percentages. So, um, like for example, on the Aussie Kiwi, the banks moved almost 14% negative on the Aussie Kiwi. So they've they've shrunk their long positions and subsequently added shorts to the tune of a differential or to the tune of 14% negative is what they've done. And the opposite's true on the NZD CAD. Okay. So that's what that is. And the this weekly COT shift, this is the signal. So this will give you kind of the overall weekly shift signal right here. So these are strong sell, strong buy, strong buy, strong buy, strong buy, based off of these shifts. And usually when these shifts get over, 7, 8, 9%, then the shift is pretty significant. Even when they're in the fives and sixes, we still regard them. In fact, even if it's over 4%, I believe it is, we still regard it as a signal. It's just not as strong until it gets to like a 7 or 8% shift. Okay, that's kind of how we view it in the scanner. Now, that brings us to the next spot. Do we want to just trust the weekly shift alone? No, we don't. We don't want to just trust this because if you only go off of the shift, you're only looking at one part of the story, right? We talked about in the last webinar about the importance of looking at sentiment, right? Which has to do with the trend of the market, right? So we want to make sure that um, we're also looking at other metrics, not just the shift, because if you look at shift alone, um, the signals are good, but you can get a lot of false signals still. So we want to try to filter those out. So how else do we filter out the scanner um, other than just the shift. So just so you know, these two columns right here, these are all about what we just talked about. The commercial shift. This column on the weekly shift, weekly COT signal, that's all shift. This where it says weekly COT shift, it's exactly the same thing. It's just represented as a percentage instead of a signal right here. That's what that number means, right? Okay, the next one is this long-term COT signal. Okay, the long-term COT signal has everything to do with the non-commercial. Okay, everything to do with non-commercial. Now, again, why do we care about these guys? Because these guys are the large specs. These guys are the ones who are generally pretty good at trading. They're trading to make money. So we want to follow these guys. Now, the thing is, these guys don't make very good decisions in the short term. Like when I say short term, like week to week basis, they're actually not pretty good. In fact, you'd almost be better off going against non-commercial on a week to week basis. I'm not kidding. We might even build that into the scanner at some point. Yeah, I wasn't kidding when I said that. But non-commercial is pretty dang good. Like they're one of the best, probably the best I know as far as picking the direction for the next month, 2 months, 3 months, 6 months. They're really good guys, like spot on good. They don't get it wrong very often. Okay. I was going to say they don't get it wrong, but I actually have seen them get it wrong, but it's really few and far between. They pretty much get it right from a longer term perspective. Okay. So that brings us to the next part of the scanner, which is this. So the long-term signal. So this will give you a signal based off of what the banks are doing from a longer-term perspective. So if this says strong sell, then we obviously are looking to, look to sell that from a longer-term perspective. It's important to recognize what this signal is because if you just see strong sell there, and you're looking to make a profit in the next day or two, you're probably going to be wrong. So that signal is very much, what you should be looking at, you know, longer term. Then you got these right here. These are all your sell signals. Aussie Kiwi's a sell. US 30 is a sell right now. US oil's a sell. Aussie dollar's a sell signal. These are all neutrals. There's quite a few. There's probably, what is that, like a dozen or 10 to a dozen trades that are just in neutral. And if I flip this the other way, you can see all the buy signals. And there's quite a few buy signals right now. These are all buys right here. Pound Kiwi's a buy. I won't name them all, but there's a lot. Pound Aussie's a buy down here. A lot of these long-term signals have actually been pretty clutch this week. Like the NZD JPY buy, that's been a great trade. Franc Yen buy, that's been a great trade this week. Euro Kiwi buy, I believe has been. I actually don't know about the Euro Kiwi. Pound CAD's been great. USD Yen's been great. I think NAS 100's been good this week. I haven't checked since this morning, but last I checked, it's gotten better. Pound Franc, Pound Yen especially, absolute monster of a trade this week. Buy. Euro Aussie's been a great buy this week. Pound Aussie, tremendous buy this week, right? So long-term data matters. It definitely matters a ton. Um, you're syncing yourself up. And when we talk about trading with the banks, that's straight up what they're doing, right? So it's a very significant signal. It's very um, valuable. But again, do you want your weekly signal to be comprised of only long-term data? No, right? That's why 1/3 of the signal is the long term data, right? Now, another thing I wanted to make sure we're going to wrap up here in just a moment, but one thing I wanted to make sure is very clear. It's I think I maybe misspoke this, or miscommunicated this. The When we're looking at the scanner, yes, 1/3 is this signal, the shift, 1/3 is the long term, 1/3 is the sentiment, but we also grade how strong something is, right? So, if something's a strong buy or a strong sell, um, that matters to us, right? If something's it matters to me that something's a strong buy versus just a buy. So that's also taken into effect too. How strong is something actually? So it takes into the cumulative score of, okay, when we're looking at just sentiment, how strong is this sentiment actually? Is it really strong or is it just strong? When we look at long-term data, is this long-term data strong or is it really strong? Right? That's what we're trying to get to, find out as well. So anyway, like I said, all of this information is compiled. And the most important thing when you're looking at the scanner, again, is always the overall signal, because the overall signal um, takes all this information, the cumulative score across all three metrics, and ultimately decides, yep, this is what we believe. These are the signals we're probably going to take, right? So these are the top trades right here. And then you've got some that are just sell signals. You got about 10 neutrals right there. And then you've got, probably what, like 7 or 8 buy signals right there, right? Pretty cool. All right, guys. Any questions so far? Lee says, I think I've only seen 1 to 3,000. Yeah, one. Yeah, that's yeah, 1 to 3,000 leverage. That's insane. 1 to 3,000. Oh my gosh. That should be illegal. I think that's what they did in the United States here. 1 to 50. Um, and I never really need to go over that. I wish I could have 1 to 100 maybe. There's sometimes I've had that when I'm using a tight stop loss, but 1 to 50 is fine, I think. I don't mind that as much. What I don't like is that I can't. What I don't like with the laws here in the United States is FIFO. It really hangs me up. There's a lot of copy traders I can't sign up for, and there's a lot of robots I can't use because of FIFO laws. Um, Same thing with hedging. Now, hedging, that one doesn't bother me as much because I'm not a big proponent of hedging. Why would you hedge? Like, there's some strategies that need hedging, right? I've used a couple in the past, but if you're hedging as a income seeking trader, it just doesn't make a lot of sense because the whole point is to pick a direction and ride that direction. So if you're hedging that direction, you're just not taking advantage of it. So I don't really mind the hedging law as much or the leverage law we have here in the United States. I really just get annoyed by the FIFO because I can't use the same lot size on the same currency pair. I have to change it up if I want to have multiple positions. I have to close certain positions before I can close other positions. Kind of annoying. But, again, that's the thing. My dad always said, it's not what happens to you, it's what you do with it, right? So you just kind of deal with the situation that you're given and then you adapt to that situation is what is all you can do. Um, yes, you try and modify martingale on Moana that had FIFO issue. Yes, that's definitely so. There's ways to get around that, Roger. So on Owanda, you can make it work, but you're gonna have to change the lot size on each buy stop and sell stop. So one of the ways you could do this is like if you're going to trade let's say a zero point zero 0.02 lot size, to start, or let's do like a 0.04 is your market order at the beginning of the week. Then if you put a 0.03 contract in as your next buy stop and then do a 0.02 contract for your next buy stop, that's a way around the FIFO law because they are different lot sizes. I've done that and that's worked. The only downside to, and this is actually, I think, a question that Lee had um, um, recently is if you put in a stop loss for one currency, the same stop loss applies for all three of them. So you can't have separate and distinct stop losses for each individual trade. it's all the same stop loss. So you kind of have to pick exactly where you're going. It really stinks, but that is what it is. So I work with it, even though I hate it. That's why I love what we do on prop firm challenges. But yeah, that's how you make it work, Roger. So, um, yeah, definitely try to do it in a demo account. If you do it in a live or a demo, I don't believe you get fined or a penalty. What happens is they just send you an email just saying, "Hey, it looks like you tried to do a FIFO violation." It's just an automated thing they send, like, "Hey, we just so you know, we don't do that." They try to educate you, like they just won't let you do it. So instead, you just learn what that law is and you just try to work around it. And so what I've done, like I said before, is to get around it, I'll just use a different lot size on each trade that I take. That also helps too. Like if you limit your trades to 3 or 4 max total trades per currency pair, that seems to help too. Because if you have an infinite amount of trades that you could possibly take on a single currency pair, then you're trying to remember, did I take that lot size already on that pair? Or did I use that right? So if you just kind of systemize it by saying, okay, I'm going to start with a 0.03 or like a 0.05, then a 0.04, then a 0.03, and that's your cap, then that seems to get the job done, you know? Yeah. Yeah, it worked. Yeah, and so Roger said it worked great on a demo and on an FTP. Yeah, totally. Yeah, I could see. Yeah, you could easily get around that on a demo account. Totally. Bill says FIFO is that first in first. That's exactly what it is. Yeah, that's exactly right. Yep. All right, guys. Well, I think this is a great webinar. I always love our COT webinar. Keep bringing your questions each class, guys. We do have a live trading call in the morning, so I'm looking forward to that. Do live trading on Friday, and tomorrow and Friday we'll close more trades and wrap up our week and get going for next week again this weekend. So yeah, I had to keep it. Yeah, I had to keep it down. Yeah, that's totally a thing with the Owanda. Yeah. All right, guys. Go team go. I love it. Okay, well, have a fantastic evening, guys, and we'll see you guys in the next webinar. Thanks for coming.